I'm Jen Beeston. Today I'm going to talk to you about interest rates, how lenders come up with what your interest rate is. Now, a lot of times I'll get calls and someone will say to me, "What is your rate today?" Okay, lenders don't have one rate for the whole day for everybody. It's not the way it works. So interest rates, the way that we determine what interest rate you're going to get is based off of a couple different things. Number one, what is happening in the market? Every single day the market changes. That's why rates change so much. It's because we're tied to the financial markets. This is a financial thing. Number two, what is your loan to value? Okay, now the loan to value and the next thing I'm going to get into, it's based off of risk. Okay, so let's picture, I don't know. I have no idea how to visualize this one. Let's just say the rate's like 4.5. That's like par, okay? That's before we add anything in. Let's just say it's 4.5. Now, if you have a really low loan to value, meaning that maybe you have 50% equity in the property or you're putting 50% down, you're very low risk. I don't need to add anything to that rate because of your risk level. Now, if you're putting down 3%, that's different. Your rate will be a little bit higher than if you're putting down 50%. It's all risk-based, okay? So same thing with credit. So if your credit score is very high, that tells the lender you're low risk. You know, you have a history of paying your bills on time. There's nothing huge and derogatory on there. Whereas if you have a very low credit score, that tells us you're a bigger risk and your rate is going to be higher to compensate for that. Okay, so banks and lenders don't have one rate for the day. So if you call a lender and you want to test them, ask them, say, "Hey, what's your rate for the day?" And if they just give you a random rate, I wouldn't work with that lender. You know, because they're not being honest with you about all the different factors that go into you actually getting your individual rate. And ultimately, it is based off of you. So if they say, "Oh, it's 4.25," you're like, "Oh, that's fantastic. 4.25 for what?" So the other thing that needs to come into consideration is the type of loan program. So for instance, FHA, VA, I would probably assume they're in that range right now, if not lower. Whereas if you said that for conventional, I'd be like, you know, every loan program has different pricing attached to it. Jumbo's different. Jumbo 5% versus jumbo 20%. Totally different rates, totally different loan programs. So if someone just says a rate without asking you how much you're putting down or how much equity you have, what your credit score is, and what type of purchase it is, they're just playing with you. So you really don't want to work with a lender that's not going to ask you the pertinent questions so that you can do the research you need. Now, I do have another video on how to shop lenders for rate because I see a lot of people making mistakes with this, but it's important to know what goes into a rate when you're shopping, okay? So remember, the things that go into a mortgage rate are what the heck is going on with the market today. So you want to shop them the same day. What is your loan to value? How much are you putting down? Or if it's a refinance, how much equity do you think you have? What is your credit score? Now, you don't need to have every lender run your credit. I would probably talk to a couple, see who you like the best, and have them run your score, ask them what your score is, which they will always give you. If they won't give you your credit score, that's weird. Like, that's another red flag. And then what type of property is it? You know, is it a house? Is it a condo? You know, condos can be slightly higher risk because you're sharing walls. There's all these different factors that go in. So you want to make sure that when you're talking to a lender, you ask them, you know, what can you offer me based on the following, okay? And loan program. The other thing to keep in mind with this is that if you're at work and your coworker's like, "Oh, you're at 4.5? I got 4%. Don't assume your lender is taking advantage of you, okay? It could be a different loan program. So sometimes if you're doing a government loan, FHA, VA, USDA, those rates are always lower than conventional mortgages. So a conventional mortgage is always going to have a slightly higher rate. However, there's pros and cons with both. So don't just assume that the person sitting at the desk next to you did exactly what you did in terms of loan to value, credit score, loan program, and what day the loan was locked, okay? So I hope this was helpful for you. If you have questions, as always, feel free to reach out, ask comments. Thanks for watching.